Um, well, we expect our GDP, as I mentioned a while ago, to average about 6.4% for 2019, and further moving up to 7% by 2020. And the key drivers for this would be the resumption of consumption spending. As last year, all of us started scrimping because prices of goods and services started moving higher. Now, the acceleration of prices is now more tame at about, we expect it to average 3.5%. So we expect consumption to rebound significantly. Plus, government is committed to accelerate their infrastructure spending, as now the budget has been passed, election is already over, administration won the majority, so hopefully there won't be any more delays on the infrastructure projects that will happen. So definitely both private consumption, public consumption in terms of government spending will definitely help accelerate GDP growth for the country. And again, the surprise credit rating upgrade is really a testament to the confidence of the ratings agency towards the capabilities of the economic team in order for them to manage the country's economy very well, and as well as the new tax programs where the government was able to have a more direct taxation. And I think that was key to the decision on the credit ratings upgrade. Okay. Next, interest rates, because as what I've mentioned, a lot of the movements in markets are dictated by the direction of interest rates. Because if interest rates start moving lower, we just expect funds to move to riskier assets, favoring more equities. And we have seen this in fact happen since probably September last year, when I saw the 5-year government rate reach 8%. Now the 5-year government rate has gone down to about 5.6%. So definitely there's been a huge correction on rates, and that is really a true testament that the market is willing to lend the government cheaper rates. And we further see rates moving lower as an effect of the additional liquidity starting next month, as the RRR cut of the BSP will take effect, and following June and July. So we'd probably expect even the 10-year yield to fall closer to 5%, given the additional liquidity, and even banks won't see any more higher time deposit rates. So I'm sure a lot of investors will start to move towards equities. And we have started seeing this already. So, relating it to the equity market, what we've seen is, because of the adjustment of interest rates going lower, the equity risk premium, meaning how much is it for you to additional payment for an investor to take on a riskier asset such as equities. Previously, because of the higher 10-year rate, the equity risk premium was practically gone. Because I'd rather invest in a 10-year bond than buy the equities or the equity market, because interest rates are even higher. But now, as interest rates started correcting, the equity risk premium started to show again, started to materialize again. And we expect the equity risk premium to continue to move higher as we see interest rates going down. So equity investors will be compensated higher as interest rates start moving lower. So the direction of the PSEI. Well, this year, we expect the PSEI to be to recover from the poor performance last year. However, in order for the market to sustain its strong uptrend, we need to see earnings. And over the last few years, earnings have not been as stellar as what we predicted. The chart here just shows you the analyst expectations on earnings. It starts with a high earnings expectation, then over the year, it adjusts lower. So every year, analysts will start at a high earnings expectation, and towards the end of the year realizing, I have to downgrade my forecast because the companies are not really earning. So it's been going down. So every line goes down. But again, this year, well, I think it's a bit different. You can see that line there, that there's been high earnings expectations at the start, then it started going down, but the line is pointing higher again. So I think, given the first quarter earnings average, at least for the PSEI component, it's about close to 11 or 12%. So for the first time, I think we can expect higher earnings expectations for 2019 as the result of the first quarter earnings. And we expect this to come from some of the conglomerates as well as the banks. We expect banks to recover strongly this year, and some of the conglomerates and the retailers as well, because last year the retailers were hit heavily with higher cost of goods and lower purchasing because of the higher inflation. So, having said that, we are forecasting the PSEI for this year to be at 8,600. So it's a 15% return from the close of 2018. I think we're slightly higher than consensus forecast of about 8,400. So we're 8,600 is a bottom-up approach, meaning all the PSE constituents, the 30 names, we've looked at it, projected the target price, and this is the result, 8,600. And at this level, it implies a price to earnings of about 18 times, and earnings growth of about 11.7%. So it's a bit healthy, it's realistic. We expect probably if earnings overshoot by more than 12%, then the price to earnings would even be lower. So it means that the market will become cheaper. And I think the Philippine market deserves a trade at a premium, given the fact that there's more earnings visibility here, given that 75% of our GDP is consumption driven. So you can see that a lot of the companies that are more on the consumption side will definitely be able to contribute to the earnings growth. So there's still a huge upside from where we are right now. I think as of today, we're at about 7.7, below 7,800. So there's still a hefty return for investors from where the market is at the moment. So there's been just some, of course, it does not go up in a straight line. Although we are quite bullish in the market, we may expect volatility down the road, given the fact that there's a lot of negative sentiment towards the US-China trade war. There's that momentary MSCI rebalancing that would add weight add more weight to China, thereby reducing weight for the other constituents of that MSCI index, which unfortunately the Philippines is part of that index. So we expect some outflows of estimated from about 100 to about 200 million US over the next few months. It starts by end of this month. Then next would be September, and then November. But again, these are just passive outflows, which as an investor can be used as a perfect timing to load up for equity funds, given the fact that we are poised to grow at a much higher pace from where we were last year, where the market was riddled with a lot of macroeconomic challenges. This year, inflation is tame. Elections are over us. There's no more overhang on midterm elections. The economy is poised to grow. There's been more pronouncements by the government of major infrastructure projects that are about to break ground, that has broken ground already. Interest rate environment continues to be supportive of equities, both globally and domestically. So definitely we have been seeing more inflows, in fact, on the Philippines. And we are not really a victim to that US-China trade war. And in fact, might be an advantage for us because we don't directly trade with those two, and there's no manufacturing here for that. So we have been seeing some channeling of manufacturing to the Philippines because of that problem with China and the US. So definitely a lot of positives moving towards the country and is supportive of growth. So both equities and fixed income, lower rates, potential for higher equity markets, then definitely financial markets would be a lot better for 2019 and moving forward. So in summary, inflation, I think it's already something not to be worried about, and it paves the way for more rate cuts. We see 3 more BSP cuts for this year as inflation continues to tame. So from the 4.75 policy rate last year, we might have the possibility of seeing it below 4% by the end of the year. The reserve requirement, again, this has been announced by the BSP governor several times that he will accelerate the RRR cut. So we have seen 200 basis points. We'd probably see more towards the end of the year, as probably they would have to time it first and see how the economy can absorb it, this additional liquidity, before they start cutting the reserves again. The 10-year rate, we can see it closer to 5%. Right now it's about 5.7. Probably expected to see break 5.5 soon, then towards 5%. The US 10-year rate, we expect it to be about 2.5 to 2.6%. So it's still within the range where it is at the moment. We don't expect it to move up above 3%, thereby disrupting markets again. So definitely it's interest rate, because of the adjustment of interest rates lower, equity markets are in favor again, both globally and especially domestically in the Philippines. Dollar peso, well, we expect this to be about 53.20 as the effect of loosening monetary policy would weigh down on the currency, together with the fact that we have a current account deficit as the government continues to be aggressive on their importation of equipment to support the infrastructure program. The current account deficit, yes, it's there, but because of the global slowdown, we might see the cost of imports going down. So we might see more manageable current account deficit because of the slowdown in the global economy. We might see importation cost of imports might go down because of cheaper goods. Impact of the budget delay, I think it has been recognized already, and I think the factors are in play for this economy to catch up. Thereby, we are still holding on to our 6.4% view for GDP growth. And again, election spending will be felt during the second quarter GDP figure. So hopefully, together with lower inflation, hopefully we'd see more consumption happening. And the US, the issue on recession, again, we don't see it happening at least for this year or by next year. If ever there is, it probably is or will be just shallow. So with that, I would leave you with our macro forecasts for the year. Just wanted to highlight, okay, GDP for 2019, we expect it to be about 6.4, further improving to 7% next year. Dollar peso, 53.20 average for 2019, and appreciation by 2020 to 52.50. And I think that those are the things that we would want to highlight. So thank you very much for your time and attention.